Summer 2026. That is the guidance that NextGen Energy gave the market for when construction starts on the largest undeveloped uranium deposit in the Western world.
Right. The Rook I project.
Exactly. So, the annual general meeting has come and gone. The permits are in hand. The first year of funding is completely secured. The summer construction season is in full swing right now. And there's still no start date.
Yeah, and for anyone tracking the physical supply of energy, that silence is, well, it's deafening.
Welcome to our deep dive into the source material. Today is Sunday, July 5th, 2026, and we are unpacking a stack of intelligence from the Uranium Unleashed market outlook for the week of July 6th through the 10th.
Which is a crucial week, despite how it looks on paper.
Right, because our mission today is to prepare you for the week ahead by extracting the actual signals from all the noise. Because, if you just glance at the calendar for the uranium market this week, it looks like a ghost town.
Oh, entirely.
There are no major corporate earnings, no shareholder votes, no regulatory decisions scheduled. But beneath that really quiet surface is this massive structural riptide.
Yeah, I'd call this a patience week with an asterisk.
Okay, an asterisk.
Yeah, because the surface data, like, the lack of scheduled press releases, implies a sleepy accumulation period. People are coming back from the July 4th holiday. But those unresolved catalysts from last week...
The physical construction delays?
Right, and the nuclear fuel supply chains, those are fully live, and they're growing in urgency every single day.
Okay, let's unpack this because that asterisk is exactly what we need to figure out for you. And to do that, I think we should look at the most visible metric of the market first, which is the price setup.
Always the best place to start.
So going into Monday, the spot price of uranium is sitting at exactly $85.70 to a pound. And it's been trapped in this incredibly narrow $1 band between $85 and $86 for over 6 weeks now.
Just entirely range-bound.
Yeah. And the only confirmed calendar event we have this entire week arrives on Friday, July 10th, when TradeTech and UxC publish their weekly spot price indicators. We're watching to see if the price breaks above 87 or, falls below 84. But let me push back on the setup for a second.
Sure.
If the spot price has flatlined for 7 straight weeks, doesn't that just imply utility demand is completely dead? Nobody's buying.
What's fascinating here is that the spot price only tells you about the traders. It shows you the immediate physical shortages, not the utilities.
Wait, really? The utilities aren't driving the spot price?
Not directly, no.
Yeah.
To understand utility demand, you have to look at the term market. The term premium, which is the price utilities are signing for these long-term, multi-year delivery contracts, that's sitting around $95 per pound right now.
Wow. So that's almost $10 higher than the spot price.
Exactly.
So, utilities are willingly paying a premium for uranium they won't even receive for years, rather than just buying the cheaper material sitting in the spot market today. That feels, entirely counterintuitive to how basic commodity shopping works.
It does, until you look at the mechanism of how a nuclear power plant actually operates. For a utility, the nuclear fuel is just this tiny, tiny fraction of the overall operating cost of a reactor.
Right, compared to the cost of building the thing.
Exactly. But running out of that fuel, that costs billions in lost baseline power generation. They aren't trying to flip a pound of uranium for a quick margin.
They just need to keep the lights on.
They need to guarantee that a multi-billion-dollar piece of critical infrastructure in the 2030s has a guaranteed, uninterrupted fuel supply. So long-term buyers are showing us that the durability and the security of a producer matters way more to them than, getting a $10 discount today.
Okay, that makes sense. So a flat spot price print on Friday just confirms a holding pattern in the immediate physical market.
Yeah, it's not a bearish signal for the industry at all unless we see aggressive, high-volume selling pushing that floor below $84.
Which means the broader market is just holding its breath, waiting for a structural signal to break the stalemate. And that brings us to the biggest component of that asterisk for this week.
The loudest possible signal.
Right, waiting up in northern Saskatchewan. Let's talk about NextGen Energy's Rook I project. Looking through the source material, this is a greenfield project holding over 100 million indicated pounds of uranium. But before we get into the timeline tension, help ground this for us. What does greenfield and indicated pounds actually mean in this specific context?
Well, a greenfield project means you're starting from absolute scratch.
Literally a greenfield.
Exactly.
Huh.
There's no existing mine, no legacy infrastructure, no power lines or paved highways leading right to the shaft. You are building a massive industrial complex in the middle of untouched wilderness.
And the indicated pounds.
That refers to the geological certainty of the deposit. They've drilled enough holes to have a very high degree of confidence that those 100 million pounds of uranium are physically in the rock, just waiting to be extracted.
Okay, and just to contextualize that scale for you listening, 100 million pounds is enough raw material to power tens of millions of homes for decades.
It's a staggering amount of energy.
Here's where it gets really interesting, because NextGen has continuously guided investors for a summer 2026 construction start, and we are deep into that summer window right now.
The clock is ticking.
And the frustrating part for investors is that all the tangible hurdles seem to be cleared. I mean, the Canadian Nuclear Safety Commission issued the license to prepare the site and construct way back on March 5th.
Right.
The final investment decision is logged. The first 12 months of construction funding, which is around 300 million Canadian, is just sitting there. NextGen held their annual general meeting on June 30th.
And it ran completely clean.
Completely clean on governance, but no commencement date was announced. It's like having the down payment transferred, the mortgage approved, the moving trucks are literally idling in the driveway, but you're refusing to sign the final closing paper on the house. Why does a delay of a few weeks matter so much here?
Because the logistics of the freeze in northern Saskatchewan are just unforgiving. That terrain is covered in muskeg, which is essentially deep, boggy wetlands.
Like a swamp.
Yeah, freezing swamp. To mobilize heavy earth-moving equipment, to build a camp for hundreds of workers, and start pouring concrete for a mine shaft, you need a very specific weather window. If you push this decision into late September or October, the ground begins to freeze, equipment becomes brittle, concrete curing becomes this massive engineering challenge, and the costs just skyrocket. The window to efficiently break ground is rapidly closing.
That sets up a massive binary for this week then. When the Toronto Stock Exchange opens on Monday, the market is going to be intensely watching NextGen's filings. If they drop a release saying, camp mobilization or site preparation has officially begun, what happens to the broader market?
It immediately de-risks the contracted supply picture for 2028 through 2030. It sends this huge shockwave of confidence through the utilities and investors, proving that a massive, complex Western supply project can actually execute on its stated timeline.
But what if they stay silent? Or what if they update their guidance to something ambiguous like the second half of 2026?
Then it forces the market to reprice the risk of when those pounds will actually arrive. I mean, if a fully funded, fully permitted, best-in-class project cannot get shovels in the dirt during their chosen summer window, the market has to assume delays.
Right.
It tests the credibility of management, and it drains investor patience, which honestly is already wearing incredibly thin.
So NextGen is the raw material side, pulling natural uranium out of the earth. But there's an equally urgent story unfolding this week regarding the next vital step of the fuel cycle. We're moving from the mine to the laboratory, specifically tied to U.S. domestic energy security.
Yeah, the enrichment story.
Exactly. Just before the long holiday weekend on June 30th, Centrus Energy signed a $900 million fixed-price commercial contract with the Department of Energy. And the focus here is HALEU. I see this acronym constantly in our source material. HALEU, high-assay, low-enriched uranium. Let's break down the actual physics of this. Why is HALEU so different from what we currently put in reactors?
Well, the standard commercial nuclear reactors operating around the world today, they run on uranium that is enriched to about 3 to 5% of the U-235 isotope.
Okay, 3 to 5%.
Right, that's standard low-enriched uranium. HALEU pushes that enrichment level up to anywhere between 5 and 20%. By packing a higher concentration of the active isotope into the fuel, you get a much, much higher energy density.
So you can basically get a lot more power out of a much smaller footprint.
Exactly. And that is the core requirement for the next generation of advanced, small modular reactors. They're designed to be smaller, safer, and capable of running for years or even decades without needing to be refueled.
Wow. Decades without refueling.
Yeah, but they absolutely require HALEU to function. Now, until this June 30th contract, the U.S. HALEU program was primarily just a demonstration exercise. Centrus produced about 1,900 kilograms at their Piketon, Ohio facility just to prove the concept was viable.
Right. And June 30th was the statutory deadline for the Department of Energy to allocate a 10 metric ton tranche of HALEU. By signing this commercial contract, which runs through March 2032 and has a total potential value over $1 billion, we are shifting from a science experiment to a commercial factory.
It's a massive escalation.
But as government desks reopen this week, the market is still waiting for formal DOE confirmation on that 10 metric ton delivery and the actual names of the recipient companies. So, how should an investor view Centrus's stock reaction ticker symbol LEU, given this huge leap from demonstration to full commercial scale?
Well, if we connect this to the bigger picture, signing a billion-dollar contract proves the demand is absolutely there, and the government funding is resolutely backing domestic fuel security.
There's always a but.
There's always a but. The bottleneck is the physical manufacturing reality. Scaling up enrichment faces severe centrifuge production constraints.
Okay, explain that constraint for us. Why can't we just, build more factories to enrich the uranium faster?
Because a centrifuge is not a standard industrial machine. It's a highly specialized cylinder, often made from advanced carbon fiber, and it's designed to spin uranium hexafluoride gas at supersonic speeds inside a vacuum.
Supersonic speeds inside a vacuum.
Yeah. They have to be perfectly balanced to a microscopic degree. If they're off by a fraction of a millimeter, the forces literally tear the machine apart.
Oh, wow.
Producing these centrifuges at commercial scale requires a flawless, highly specialized supply chain that has, unfortunately, essentially atrophied in the West over the last 2 decades. So the market will be watching the DOE confirmation this week to see if the timeline for standing up that supply chain is holding, or if the physical reality of building these complex machines is causing the statutory deadlines to slip.
Okay, so that structural bottleneck in the U.S. really highlights how exposed the entire global supply chain is, which forces us to look beyond North America. And the source material outlines some pretty severe geopolitical background noise happening this week.
Very severe.
And to be absolutely clear to you listening, we are analyzing these global flashpoints impartially, strictly through the lens of supply chain arithmetic and how they impact the uranium market. We're not picking sides here.
Just following the pounds of uranium.
Exactly. First, the U.S.-Iran nuclear negotiations at the Birkenstock Resort in Switzerland. We are currently 18 days into a 60-day window following a June 17th ceasefire memorandum. Iran holds 408 kilograms of uranium enriched to 60% or above at their Fordo and Isfahan facilities.
Right, and then you have the situation in Niger with the French state-owned nuclear company, Orano.
Right. That revolves around the ICSID tribunal order. ICSID is the International Center for Settlement of Investment Disputes, basically an international arbitration court. Their order bars the Niger government from selling uranium from the Somer mine. Concurrently, the Cotonou export corridor in neighboring Benin remains completely closed.
It's a total logistical gridlock.
The result of those closed borders is that 1,800 tons of Somer stockpile is effectively stranded in Niger. For context, 1,800 tons is roughly enough to fuel nearly 10 massive nuclear reactors for an entire year. It's just a massive chunk of energy sitting in drums.
And this regional instability is also pushing the timeline for Global Atomic's DASA project out to 2027.
Yes, exactly. And finally, the source material highlights the Kazakhstan-China squeeze. Approximately 67% of Chinese uranium imports are coming directly from Kazakhstan under sovereign bilateral contracts. Meanwhile, Chinese demand is rapidly expanding. They're on track to double to over 30,000 tons of uranium by 2030.
That's the real elephant in the room.
So what does this all mean? Let me pose a challenging question to you. If this 60-day window in Switzerland leads to a diplomatic breakthrough and Iran agrees to downblend their entire stockpile of highly enriched uranium, doesn't that flood the global market with usable fuel and just crush the spot price?
Well, I mean, that is a really common concern, but we have to run the math on the actual volumes. The geopolitical risk premium, which is the fear of sudden supply shocks that only affects the floor of the spot price. Iran's domestic uranium production capacity is roughly 100 tons per year.
Okay.
Global demand for uranium is currently running north of 65,000 tons per year.
100 tons out of 65,000. I mean, that's practically a rounding error.
Exactly. It barely moves the needle on the structural deficit. No amount of diplomacy with Iran or Niger solves the massive supply arithmetic problem caused by China.
Right, the 67%.
When a sovereign entity like China signs a bilateral contract to lock up 67% of the output from Kazakhstan, and Kazakhstan is the world's largest producer, those pounds are permanently removed from the open market.
They just vanish.
Western utilities looking to fuel their reactors cannot bid on that material. It's simply gone. That $95 term premium we discussed earlier is a mathematical reflection. We have the largest supply pools on the planet.
Okay, so if the physical gears of the industry are grinding and the long-term structural deficit is cemented, regardless of, diplomatic breakthroughs in the Middle East, we need a way to measure the current temperature of the equity markets in real time. Because sometimes the stock market just completely ignores the physical reality of a commodity.
It happens all the time.
The source material points us toward Yellowcake. Yellowcake, ticker symbol YCA, on the London Stock Exchange, launched a $10 million share buyback mid-June on a 60-day clock. How does a listener use Yellowcake's weekly repurchase disclosures as, a mood ring for the broader market this week?
This raises an important question about how physical trusts operate, specifically regarding net asset value, or NAV. You see, Yellowcake does not mine uranium.
They just hold it, right?
Exactly. They simply buy physical uranium and store it in warehouses. Their intrinsic value is derived directly from the spot price of the uranium they hold. When their stock price trades at a market capitalization that is lower than the actual value of the uranium sitting in their vaults, that is called trading at a NAV discount.
So it's like having a vault with exactly $100 inside, but the stock market is saying the bead to that vault is only worth $90.
That's a perfect way to put it. Under those conditions, the most logical move for Yellowcake management is to use their cash to buy back their own stock. They're essentially buying physical uranium at a 10% discount.
Right, that's just smart capital allocation.
But the metric to watch in their disclosures this week is the narrowing of that spread. If Yellowcake is buying aggressively, using up that $10 million allocation, yet the NAV discount remains wide, it reveals a really stark truth about the broader equity market.
It shows that equity investors are dumping the stock just as fast as management can buy it.
Exactly. It signals severe equity market apathy. It means the stock market is completely detached from the strength of the physical uranium market.
That's wild.
The physical buyers, the utilities, they're signing $95 contracts because they see the catastrophic cost of running out of fuel. But retail and institutional equity investors are, bored by the lack of immediate catalysts, so they sell physical trusts at a discount. Watching that NAV spread this week will quantify exactly how wide the disconnect is between the physical supply reality and equity sentiment.
Wow. Okay, while you are watching that NAV spread, I want to briefly outline what not to look for this week so you aren't waiting around for news that just isn't coming.
Always good to clear the board.
Right. The calendar is deliberately clear of a few major events. Cameco's Q2 earnings are not scheduled for this week. You should expect those late July, around the 30th or 31st.
Right.
Fortis Metals AGM, where John Borshoff formally assumes the CEO role, is also on July 31st. And Sweden's amended uranium mining law, which simplifies their environmental permitting regime, does not officially take effect until next week on July 15th.
Filtering out those events really helps focus your attention entirely on the unresolved tensions in the current week.
Exactly. So to bring this entire market outlook together for you, this technically quote-unquote quiet week is actually a psychological battleground. The underlying structural deficit of the uranium market is actively being tested against investor patience.
It's a staring contest.
It really is. As you move through your week, focus on those two specific catalysts. Watch the TSX filings for NextGen to see if they finally initiate site preparation for the Rook-I project in Saskatchewan. And watch the Department of Energy Communications for the HAU 10 metric ton confirmation, just to see if the U.S. commercial fuel cycle is hitting its statutory deadlines, despite those massive centrifuge manufacturing constraints we talked about.
And as you track those developments, consider this final thought.
Go ahead.
We spent significant time analyzing NextGen and the intense market anxiety surrounding their construction start date. Remember, Rook-I is a fully permitted, fully funded, highly anticipated greenfield project managed by a well-capitalized team.
Right, they have everything going for them.
If the absolute best-in-class project in the Western world takes this much time and generates this much friction just to officially break ground, what does that say about the reliability of the rest of the unbuilt development pipeline?
Oh, wow.
The global nuclear renaissance is desperately counting on dozens of far less mature, less funded projects to come online by 2030 to keep the reactors running. If the strongest runner in the race is facing this much resistance at the starting line, how impossibly steep is the hill for everyone else?
That throws a completely different light on this quiet week. The surface might look still, but the structural forces underneath are pulling harder than ever. Thank you for joining us for this deep dive into the source material. Keep your eyes on the data, and we will see you next time.